Director of Raffinger's Wealth Management, and in today's episode I'm going to take you through what venture capital trust VCTs are and enterprise investment schemes EIS are, the investment opportunities they provide, the tax reliefs available, and how they can be used as part of a diversified portfolio. So to start with, I think I always explain venture capital trusts and enterprise investment schemes as in essence a collective investment fund, an investment fund that invests in early stage startup companies. So because they are early stage startup companies, these are regarded as high risk investment vehicles, and that is why they should always be used as part of a diversified portfolio. Now, because they are high-risk investments and you're supporting British industry, the government provide some quite attractive tax reliefs on the way in to an investment and on the exit of investment as well. So what I'll do, I'll start to discuss the tax treatment of venture capital trusts first and move on to EIS thereafter. So the maximum you can place into a venture capital trust in any 1 year is £200,000. Now, once you place £200,000 into a venture capital trust, the government will allow you to claim 30% income tax relief on the sum invested. So for every £100,000 you invest, you can claim £30,000 tax relief, meaning that your net investment is £70,000. Now, venture capital trusts also pay income. That's in the form of dividends. Now, the dividends, if paid, are completely 100% tax-free. They do not have to be declared on one's self-assessment. So you have the income tax relief on the way in, bringing your net investment down, and you also have the ability to receive a tax-free income stream. Now, for clients of mine, for those building towards retirement, and for those that feel that what may be a high rate taxpayer in retirement, then what you can do with a lot of VCTs within the marketplace at the moment is any income that is paid from a VCT, you don't actually have to take the income, you can actually reinvest it back into the VCT. Now, that reinvestment of dividend is actually regarded as a new contribution to the VCT. So you then also get 30% income tax relief on the reinvested amount also. Now, once those clients reach retirement and need to draw the income as an income stream because perhaps their income from work has ceased, then you could stop the reinvestment and start to draw the tax-free dividends as part of your diversified income portfolio. Now, VCTs are listed on the London Stock Exchange, so they're very transparent. And when you exit a VCT, any gain that you make within the VCT is also tax-free. Now, when you invest in a VCT, you have to invest for a minimum of 5 years. This isn't a 1, 2, 3 year investment time horizon. This is a long-term investment time horizon, which is as it should be when you're investing in early startup or early stage companies. And early stage companies, because the government have specific rules in place to limit the type of companies that the VCTs can invest in. So that's VCTs in a nutshell. They are high risk investments and they should not be entered into lightly, and you should always take advice before entering into such an investment. Now, in terms of enterprise investment schemes, the maximum you can actually invest is actually £1 million a year. And they also offer 30% tax saving on the way in. They also have a restricted pool of investments in terms of the types of companies they can invest in. In terms of EIS, you can actually get a fund or a single company EIS, but that's extremely high risk. What we tend to invest in are packaged EIS funds that might have between maybe 5 to 10 investments into single companies within the fund to reduce the risk. I mentioned VCTs are listed on the London Stock Exchange, so they're very transparent. EISs are not listed on the London Stock Exchange and by their nature are very opaque, so you won't really know what's going on until such time as you get your quarterly, 6 monthly or annual statement from the EIS provider giving you an overview of what's happening beneath the bonnet of the EIS. Exits within an EIS are also tax-free. the minimum holding period for an EIS isn't 5 years like a VCT. It's actually 3 years. EIS do not pay any income. They're a pure growth play. Sometimes with a VCT, if an underlying company is sold for multiple gain, or in terms of multiples on the original investment within that individual company, you might get a special dividend that's paid from a VCT, and we've seen that many times whereby a special dividend is paid tax-free to the individuals. Now, one of the things that EIS funds offer that VCTs do not is some quite attractive inheritance tax relief. And what I mean by that is the companies that EIS providers invest in should or do qualify for something called business relief. So what that basically means is after 2 years of trading within that qualifying company, that investment will not form part of your estate for inheritance tax purposes. I don't tend to use EISs for inheritance tax planning, but it is an added benefit. You also get something called loss relief from an EIS. So if you, for example, sell a share that isn't a VCT or an EIS, so let's just say, for example, you own shares in BP. You buy 100,000 shares and BP, and you sell them at £50,000. There's a £50,000 capital loss there that you can use to offset against future gains, but that's a capital loss. If you make a loss within an EIS, so let's just say you invested £10,000 in an EIS, and every single investee company fails, and you lose £10,000. But your investment was actually £7,000 after the 30% income tax relief. So what that basically means is you actually have lost £7,000. Now you can actually claim income tax relief at your marginal rate, be that 20, 40 or 45% via your self-assessment. So it gives you some downside protection. And I have used that in the past. What you have with collective funds such as these, you will have some winners within the fund and you will have some losers within the fund because of the nature of the types of companies they're investing in. Now, in terms of the marketplace and in terms of the market and how buoyant the market is now, what we have seen over the last few years, and I mentioned it in a previous episode about pension contributions for high earners, the government have restricted the amount you can have in a pension plan, and they've also restricted the amount you can pay into a pension plan. So what high earning individuals are doing is they're fulfilling, for example, pension allowances, ISA allowances, and with excess cash or capital that they have, they may look to use EIS and venture capital trusts within a diversified portfolio because an individual such as ourselves cannot get access to the types of companies that venture capital trusts and EIS are investing into because they have collective bargaining power and funds available to go to companies and say, we want to invest in your company, not just buy £10,000 worth of shares, maybe invest £500,000, £600,000, £700,000 for the collective fundraising for the clients within the scheme. As I mentioned before, these are high risk funds, they're not low risk, and for clients of my own, we would tend to use these as a satellite position within the portfolio that we look after for clients at the high risk section because rewards are commensurate with the risk that is being taken. So there is some quite large downside risk as well. So all I would say is if you are thinking of investing in EIS or venture capital trusts, because they are widely publicised in the press now, the providers in the marketplace has grown, the sums being invested in such schemes has grown over the last few years. I would ask you to contact your references partner, or you can find my contact details on the website, and I hope to see you very soon.